Good evening, everyone. One moment while I get everyone up on stage for this evening. Cool. Welcome to everyone coming on to this evening's session. I'll just wait for the guests to come up on stage, but in the meantime, feel free to let us know who you are in the chat. It's nice to know who we're talking to. Cool, everyone's coming up there. Cool. The Relab team are excited to be bringing you the second development session with Subdivision NZ tonight. This evening session is all about development finance. My name is Kirsty and I'm the Content and Social Media Manager at Relab. And joining me on stage today, we've got Kirsty, Bespoke Auckland Developer and Subdivision NZ Admin. We've also got Paul, Director of PJM Project Management and also a Subdivision NZ Admin. And tonight we're joined by Ben Pauley from Lateral Partners. As Director, Ben specialises in working with developers and businesses, large investors, to better provide them with lending, equity and transactional solutions. But just quickly before I hand over to the Subdivision NZ team, I've just got some admin-y things for the webinar. If you've got any questions, please pop them in the chat and we'll get to those at the end. We've also got Ben, creator of and admin of Subdivision NZ in the chat, monitoring the chat box as well. You will receive a recording of the webinar later on in your inbox after the session wraps up, just in case you miss anything or you want to go back to the recording. And also just a disclaimer that everything discussed in this webinar is purely just based on personal experience. Please consult a professional before making any decisions, as it shouldn't be taken as professional advice. With that said, I'll pass on to Kirsty, Paul and Ben to provide tonight's information.
Thank you very much, Stacey. Yes, we've got Ben here. I must say, I only met Ben very recently. The reason I met Ben was because when I was starting my development, I didn't have much information, and eventually I found a site, Lateral Partners, and they seem to have blog articles. Somehow I signed myself up for that, and my inbox started getting spammed with articles. And after a while, I realised they were actually useful.
Oh, thank you.
Yeah, you're welcome, Ben. And I ended up linking one on to Subdivision New Zealand and having a bit of a conversation with you in following that post.
Yes. Yeah.
So yeah, it was useful. So what I can say is that we've had a very interesting 2 years, and I use interesting as the word. It was exceptionally challenging. And going forwards, I'm expecting it to be challenging also, maybe less unpredictable, but also maybe even harder than it has been. So tonight, what we're going to do is we're going to review Paul's feasibility that we went through 4 weeks ago with Ben Pauley, the expert, because what we know is that Paul and I are definitely not experts with finance.
No, not in finance.
Yeah, absolutely not. So what we want to do is find out what Ben thinks of its viability or its bankability. So that's the first part. The second part, we're going to take a sidestep and we're going to talk about the macro environment, because the macro environment affects our developments. It's not two-dimensional. We have got a component called time, and in time things change. So that is vital in property development, so we will be touching on that. Then finally at the end, and it's really quite important that we cover this, but it is being covered at the end, not at the start. We don't need to do things in order. Ben Pauley is going to actually discuss what he would like to see from a developer, when he would like to see a developer, and what he thinks he will do or any broker would do through the finance work stream. So that's what we plan to cover in 3 hopefully clear sections, and they will kind of jump from 1 to 2 to 3, not necessarily a nice clean slide because there are 3 components. So let's get on to part 1, which was Paul's feasibility. Now, I of course went through your numbers again, and I've got some good and bad news for you. Maybe I should be starting with the bad. What's bad news for? So when we presented the last feasibility, we realised that your costs had gone up.
Yep.
Your product cost had gone up, so the inputs were nicely steeper, including your finance, and we'd also reduced your selling point because no one was going to pay what you thought you wanted.
Yeah,
Yep.
sad but true.
Yep. But one thing we hadn't done was we had not looked at your land. And I'm happy or unhappy to tell you that you've just lost $150,000, Paul.
Yeah, unfortunately everything goes down, and in the feasibility we basically had the original land value, and if I was to sell that land I wouldn't realise what we had in the feasibility. So we were taking money off the new product, but we weren't taking money off the land value.
Yes.
So the difference wasn't real, or isn't real.
Apples and oranges.
Yeah,
Yeah.
correct. That's a good way of putting it.
But it does make your feasibility look less dead. It took a breath. It took a breath, didn't it?
It did.
It
on
did.
life support.
Yes. So now what we want to do is you've looked at Paul's feasibility.
Yeah.
You've had it for a couple of days now,
Yes.
and
Yeah.
all that spare time you've got.
Yeah, and all that time I've got.
Yep. So what we'd like you to do is chat it over with Paul.
Mm.
From my perspective, I just want to make sure that you're covering, does it stand on its own merits? What are the measures that you're using and what do they mean?
Yes.
So when you're talking about a measure, if you can just spell it out
Yeah,
slightly,
yeah,
which would be good.
Yeah.
What are the financing options that may be open to Paul? And is there anything Paul needs to do to make it more alive, like
Yes.
take more than a breath? So I hand over.
Cool.
And if you chat to Paul about it.
Oh, thank you, Kirsty, and thank you, Paul, for sharing the numbers. Obviously, so I guess sort of when I first pick up a feasibility, there's a few things I do. So the first one is going through and look. I'm not a quantity surveyor or the like, but you see enough feasibilities, and it's just making sure nothing stands out like a sore thumb.
Yeah, high level sense check.
Yeah, that's exactly right. And when I looked at this, most things looked about right. The one thing I had some questions around was the spend on professionals with the resource consent, building consent and things. And I know, talking with you and knowing you, being in the industry, you're probably able to do that more efficiently than others.
Yeah.
So that kind of, we were able to get to the bottom of that. The other thing that was great to see in there as well was the contingency figure. So you had $100,000 in there for contingency, which worked out to be about 9% of the build cost. And that's around where the market wants to sit at the moment. ANZ's starting to push towards 15% on contingency, and some lenders are up there. But you definitely want that sort of 10 to 15% number. Sort of 12 months, 2 years ago, you could get away with 5%. It's definitely that 10% number now, particularly with inflation sort of coming through. The next thing we look to is the margin on the development, and that's probably the ugliest piece of this feasibility. So unfortunately, so when we work through, and we've used GST inclusive numbers here because, as I understand, you're looking to hold on to the properties. There's about a $300,000 margin, which works out to be about 10%, which is well below where we want to target for a margin on a development. Typically speaking, a lender would target something north of 20%. You can get away with something slightly under that, but really we want to be pushing that 20 to 25% mark. So 10% is definitely not going to cut it. And I'll come back towards the end and maybe readdress that as well when we talk about whether we can bank this development or otherwise. The next piece that we look for in the puzzle is the equity. So I noticed in here there's about $600,000 equity in the project, and that's the cash spend to date, less the debt owing on the property.
Yeah.
And that is about where we'd see a transaction like this. So this is a 2 4-bedroom home development. This is something we'd look more in the retail side of the bank than the property finance side of the bank to put that through. And the retail space would definitely look at a 80% loan to cost ratio. And in simple terms, what that means is relative to the total cost of the project, how much is the total loan you're taking on? So you're borrowing 80% of the total cost of the project. Understood?
Yeah,
makes sense.
Yep. Just an interesting question. So I think this would probably be a relatively safe development because they're 2 freestanding houses. But if I was to come to you with, say, the scenario where we did, say, the 6 apartment 3-story walk-up scenario, would that change the minimum equity? Is there at what point does the risk profile go up?
Yeah, and it would. So typically, most of the banks will range anywhere from 2 to 4 properties that they'd consider through the retail/business side of the bank, which is more the retail lending criteria and that 80% of cost. Once we start looking at something like 6 3-level walk-up apartments or 6 townhouses or something similar to that, the equity number does start to step up, and typically the banks sit around 70% loan to cost, so 30% cash equity in a project. Okay. So if a project costs you $6 million, you want $2 million of equity in there and your spend today. So winding back, I know this is a build to hold. I had a couple of questions relative to that. So the first one was around sort of getting an understanding maybe, because there's a low margin in the project, an idea of I guess how long ago you bought the land and maybe what you paid for the property. Is there sort of a rough idea of that? I don't need to give too much away.
Yeah, so look, it was bought, this particular scenario, this property I think was bought in 2007, and I think it's safe to say that it's more than doubled. So,
yes.
So yeah, the 600k equity number would be a conservative number, and it reflects something that's gone up 3 times its value. Yep.
Yeah, and so I know that the feasibility we've sort of got presented on the screen has taken GST off the numbers and added it back towards the end.
Yep.
And if we look at the land value, we've got 1.13 excluding GST, which would round up to roughly 1.3 million including.
Yep.
And so it's sort of safe to say there's a good, like you said, a good margin there in property. And this is a conversation we often have with clients, more so if they've purchased a property more recently around, is there a good margin to be made in just selling the property free of tax, free of development risk, as opposed to taking on the development and that risk for a low margin. But we do know this as a hold, and as you've alluded to, the properties are in a good area. They're good freestanding homes, and there might be a more long-term objective to that. And so sometimes we do deal with developers where the margin is lower than 10%, particularly on a 2 or 3 bedroom, 2 or 3 property development. But there's a yield play, a rental return play, and a future capital growth play. And if we were looking at something like this, I'd be comfortable taking it to the bank, but I might sort of seek for further equity put into the project and to reduce that LVR on completion and just to sort of shore up that project a little bit. So look, overall, not something I'd necessarily be keen to jump out of bed and present to the bank right away, but if we had a discussion and we understood that the goal of the property and the project, and we were able to introduce a bit more equity, I definitely think that's something we could present to the bank and take further.
Okay.
Is there any questions you had, Kirsty?
No, but did you clarify what the LVR was, loan to value?
Oh, sorry. So you're quite right. There's two formulas that quite often get mixed up is loan to cost versus loan to value. Both are very important ratios to understand. In very simple terms, loan to cost, as I explained earlier, is the loan relative to the total cost of the project, and that's your representation of the true equity that you have in a project, the true cash that you've injected into the project. Loan to value ratio is the loan relative to the value on completion. And that is informed obviously quite a lot by the margin. And you can find a project that has a very strong margin, so you have a very good LVR because the value at the end is very high. Yeah. However, if you don't have enough true cash equity in, i.e. you have a high loan to cost ratio, it still may prohibit you getting the funding for your project. So both are equally important to talk to.
Okay.
Can I just one point there, and this is something I learned, is that the costs I had spent on my resource consent for some banks was regarded as equity, but some banks didn't. One particular bank didn't.
So there's quite often we can use the cost. So when we look at a project, we can either take what you paid for the land plus all your costs today. And most development projects, the time between land acquisition and development is relatively short for developers that do a lot of projects. For some people, they may have been sitting on the land for a period of time. Where it can get muddy is if we have a valuation as at today that includes the consent in the property. It's about double counting costs. So if we take the land when you bought it plus the cost of the consent, there's a value number there, or the value of the property with the consent is here. If we count both that and the cost of the consent, we're in effect counting it twice. So there's sort of two choices you can sort of have as to how you present that to the bank, and normally you can kind of go down the path of which is the better outcome for me.
Yes.
And quite often that would be the value with the consent in place. But yeah, it's just important to sort of understand the differences. Again, sitting down and talking with a broker or financial advisor, they should be able to help you sort of discern which is the correct way to present that to the bank.
Good. Thanks for that, Ben. So clearly we have got to the point where we did a feasibility, or Paul actually did a feasibility some time ago. You had a nice project. I know you've been quite keen on this project for some time. You started with something like, was it a 25% margin?
Yeah, it's still a nice project.
Yeah, no, it's a nice project. It's a nice project with a nice render on your desk.
It is.
Yeah,
Yeah,
it is nice.
It's a nice render. So,
Yep.
Further to the previous webinar that we did, it's obviously with construction. Just to recap, we did a scenario where a project was looked at about 12 to 18 months ago. It was based on construction costs back then. It was based on borrowing costs back then, because this is a hold, so money was half price basically. And since then, what's happened is construction costs have gone up about 20 to 30%. The cost of money has doubled, and the houses are probably worth 10% what they were off their peak. So that 20 to 25% equity gain, and something that was going to be cash flow positive from a rental perspective, has been neutralised. And I just want to recap that we're using this project as an example, because there'll be many people who will have similar projects where you're taking an existing property, it's been rezoned, and you want to know whether you can add value through it. So we're deliberately using a project that's not a perfect scenario, but a scenario that many people may have.
And your final word, Ben, is this bankable?
Well, yeah, sort of as I said before, I think if we took a bit of money to the table and there was a good servicing argument, we can definitely take this forward.
Yeah.
There is merit to saying that, if we hold through a couple of cycles and two standalone homes in a good location will hold up in value. So it is bankable with a little bit of massaging and a good broker and a bit of work. But it's definitely something that you want to sort of work through the risks and understand what you're taking on before you get into it.
Yeah, I think it's important to just recap a comment that Ben touched on, and that is that all the money in this project is in owning a piece of land and going through 2 property cycles, and most of the money sitting in the land and not actually sitting in doing a development. So if we go through a development exercise, there's a paper profit in today's money. It could be 10%, but the lion's share of the money, if the purpose was to make money and sell a property, is actually sitting in the land. And you and I are having a good discussion about many clients that we see going to great effort to potentially do a building project to make this much sort of money when most of the profit sits in the land, and they could simply just choose to sell the land.
100%, and they don't take on the development risk. There's little to no tax obligations. It's a much cleaner way of going about it sometimes. Yeah,
so sometimes you've just got to be careful that you're not stuck in tunnel vision of wanting to do a development for the sake of doing a development, and just stepping back and looking at the bigger picture and what your objectives are.
Yeah, like 100%. You've been forced to do.
Yeah,
unfortunately.
Sell the land.
Yes.
Yeah, I know, but it's still a pretty render.
I know it's a pretty render, and it's very nice. It'll be nice on your calendar.
Okay, thank you.
So next year's Christmas calendar for your mother.
Okay, thank you.
So now we're going to move on to the second part of the webinar, which is talking about the macro environment. So when Paul and I finished the webinar 4 weeks ago, one thing we had a chat about was we wanted to go through finance. And one key aspect was the time value. So finance doesn't work in two dimensions, where you go in, you think you've got finance sealed up, and then you go in, you do your development. Something happens called time. And during time, things change. Time's dynamic. And I think the journey that I've been on has been, would you say, quite dynamic, Paul?
Yeah, it's been dynamic.
It's been dynamic.
Pre-COVID,
Boom,
post-COVID, then
A bit more. So yes. So to summarise, we had when I started, Kiwi Build was initiated, which changed the expectations of prices and the product types. We then had COVID. We then had the fear that came in with COVID, and that was when I had pre-sales there. My nameless dark blue bank that I had a good relationship with changed their lending criteria because the market had changed. So they needed to change their criteria. That then meant for me that I wasn't going to achieve the goals that I wanted. But they needed to manage the risk. They were managing my risk, but it wasn't managing where I wanted to go. I then had a materials price change review. That wasn't very pleasant. I then had 2 subcontractors through the process. One early on that managed to sit on a deposit that I paid, and they were closing up shop. So I learned all about the Credit Constructions, the Credit Act of 2002 or something. I got my money back, which was valuable because that was $50,000. We then had someone else go under, which pushed up my fire costs quite a bit. I then had Alert Level 4, that really nice day on August 17 last year when we got shut down. That was not nice because I had a TMP in place.
This is why a 10% margin's not enough, Paul.
Things
change.
Yeah.
Things change, yes.
Okay.
We then had the CCCFA come in, and the finance environment changed. That my refinance deals changed, and I think I went through them twice. And for me to get all my material together for refinancing takes a lot of time, and it involves getting documents from people, tabulating it, pulling it together, creating a Dropbox. It takes time. We then had the nice present of Omicron, and Omicron slowed everything down, and it really dried up resource available. So the environment for me was extremely dynamic, and everything changed. So finance is critical to a development unless you've got very deep pockets and you don't need to borrow money off anyone, and you need to factor in time. So that was my experience. And what I'd like to say is, Paul, you've been operating this area for quite some time and dynamic.
Yeah.
What are the things that you've seen through the past 18 months to 2 years?
Okay, so I think the big change is the funders' focus and certainly heightened awareness of risks and risk management. So I think it used to be, a fairly sleepy process in the past, and now it's a very dynamic process. And the banks and the funders' responses are they want a lot more information, and they are getting far more actively involved in understanding projects. So I think in the good old days, you used to be able to just get a QS report, or if the person had a lot of equity, you might have got away with a project manager's report, and the banks would have done drawdowns on the basis of those. Now what's happening is you've got people that actually work within the bank, and they're reading the reports and understanding the project and where it's actually at, and testing and challenging things. So you can't just slide reports and saying last month we were on program and this month we're 2 months behind. They will come back and they'll sit there and say why and what are you doing to mitigate it. So from a bank's perspective, that they are aware, or a funder's perspective, they're aware that there are time risks at the moment with these lockdowns, with productivities, with shortages of people resource and labour resource and materials, and that they're aware that we've also got escalation, and that some contracts allow contractors to recover escalation costs. So from their perspective, the understanding, what a bank is trying to understand is, or a fund is trying to understand is, what the forecast final cost is, and when your settlements are, so that when they're going to get their money back and they can recycle it. So they are being put under pressure, and the response is that they're asking for more comprehensive reports with respect to time, with risk, with procurement schedules and mitigation strategies, and are really understanding what's going on your project. It wouldn't surprise me in some cases if they're actually doing drive-bys.
And how are you finding good developers, good borrowers are sort of dealing with that increased scrutiny from the banks? Like how are they sort of going about that?
So it comes down to quality of reporting and using consultants to assist in verifying that quality of reporting. So it's QS reports, it's contractors providing reports and updated comprehensive programs, it's project managers like myself going through and verifying these things and providing commentary around it. So it's a lot more detail.
And there must be a bit of value there for the client though as well, right through that process, not just the bank, but the client
absolutely.
also. Yeah.
Well, it's forcing everybody to sit down and understand what's going on with your project and be honest with yourself and do the homework. So it's kind of, if we were to use sort of like that old school example of, you know, like a school exam, you can't just come up with the answer. You've got to show your workings, and that's what they're wanting. They're wanting to see the workings, and they're testing and challenging the workings to validate it, because I mean, there's a funding squeeze at the moment. You know, banks are wanting to know or funders are wanting to know what things are going to cost, and they also want the money back, because as you're well aware, there's a pile up of developers wanting to do projects and there's no money.
Yes.
And what people are trying to figure out is, well, when is this project going to settle so I can free up the money to fund the next project? So it's creating a traffic jam with projects, and so the only way that people can report with some honesty and genuine understanding is detail.
Oh, cool.
Anything you want to add with what you've noticed from your perspective? Or
No, I think Paul's more or less hit the nail on the head. Sort of procurement and program are the key focuses for the banks at the moment. The cost escalation piece is quite important, and that harks back to negotiating a good contract up front, and making sure you don't get stung with big cost escalations or other things that are outside of your control.
Or knowing and understanding your risk. So
and I think it's particularly important having good consultants in the middle to sort of mediate between yourselves and the bank, and it's not necessarily an us and a them, but if the bank had their options, they would have everything legislated to the nth degree, and often that doesn't always result in a great outcome for the borrower and the builder, because you might be placing too much risk on one side of the equation. But having those right people in the middle to sort of get a fair and reasonable contract is quite important. Yeah,
the other thing is too, there's a change in dynamics. So if you've got a project that was maybe signed up, say, a good 12 months ago, 18 months ago, and it took a little while to get started on site, and now it's underway, the dynamics of the way that I guess a deal was done and the expectations on the contractor and payments was very different to now. So now what we're finding is that deposits are required, and so
for materials.
Correct. So material deposits are required, a lot more than they used to be. So if we wound back the clock, say 3 years ago, on a residential project, I'd typically only expect to see deposits for windows. Is pretty common practice for a 50% deposit for windows, because it's a bespoke item to a specific house. You can't reuse the windows on someone else's if the project doesn't go ahead, or something that was really bespoke, like if somebody's got a really expensive and unique stone bench top or something. There were elements that were of bespokeness that required deposits, and now what we're finding is many and most suppliers are requiring some form of deposit to secure materials. So that procurement, so what we're often doing now in the beginning of a project is we're sitting down saying, well, what are the risks? And the first risk is material supply. And we sit there and we go, and escalation associated with it. And we're sitting and saying, so how do we manage that risk? And what we do is go through on a trade by trade basis, saying, well, let's order things now so we can buy it in today's money. And to secure something in today's money, the supplier or the subcontractor the other end is often wanting a deposit in return. So it's kind of changing the dynamics in that we're now doing what we call a lot of off-site payments. So without sort of diving into too much detail, normally you value progress either on milestones or basically on something that's fixed in place. So once a month, somebody will go to site, they'll measure the quantum of goods that are fixed in place, and we'll pay on that. So say if 60% of the weatherboards are installed, we'll pay 60% of the weatherboards. But now what we're finding is that we're having to, like if we take the weatherboards, for example, what we're doing is we're actually having to order them literally in the first week of awarding a contract and secure them. So basically, often the first progress claim will have a packet or 2 packets of weatherboards sitting somewhere, which the owner is actually paying for in advance and taking off-site possession of to de-risk other associated risks with program and supply and progress. So what's one of the interesting things is often the first interestingly the first progress claims are often disproportionately high now. So we've got a project now that round numbers is $11 million, and the first progress claim is north of $1 million, whereas normally I'd expect it to be a couple of $100,000 for some site establishment. and basically it's close to $1 million in off-site payments.
So you're front loading your debt as well, so your cost of
Yeah.
money or the cost of funding is going to go up.
Yeah, well, it will, but conversely, off on the other side of that, that means
You're
that
de-risking the program delays.
and if you're funding for 12 months versus 15 months, 15 months is going to be more expensive as well. So there is a trade-off there. And is that quite a collaborative approach with the funders that you're taking on? So that's explained.
Absolutely,
yeah.
Because the fundamental risk is people are kind of happy paying for something when it's fixed in place on a building. It's kind of, it's there. But when there's
sitting in a warehouse,
when there's a packet of timber that's sitting in a warehouse, is that for your job, or is that do we do an offsite claim for that materials for that person and then rip off their name and put someone else's name on it and that's for the next person? I'm being a little bit flippant when I say that, but if it's not fixed in place and it's somewhere remote, there's multiple risks with regards to theft. Fire, other bits and pieces. There's a whole lot of different dynamics with the risk of that.
Yeah, okay. Cool.
Okay, so obviously we have gone through our macro environment. We've also reviewed Paul's feasibility, and now we get to the final section, which is actually really important, and a section that I wish I had understood early on, which is what does a person need to do to think about finance. So, when do we approach you? What details do you need? What is the journey like with the finance people? Yes. Are there gates that you need to go through? And, are there any contract or any other negotiations that you need to be involved in? So I'd be quite keen for you to tell us about that. And I think we've got a slide that's covering some key components there. That might, Stacey, if you're able to, or someone able to put it up so that people can see what's required. And also some comments on risk mitigation.
So I think to sort of, I might not quite address each point as you raised it.
You don't have to. There's no rule here.
So I think, the first thing is to put an application together and what a financier wants to see. And the real gateway, I guess, to that, if you will, is resource consent. That's your permission document. You can do this on site, etc. So most funders won't even consider a development application until resource consent's in place.
And just so people want to know why can't you do funding until you get a resource consent in place? Because a resource consent basically says you can legally build that form, that bulk and location, the quantum of units that you want to do, and it gives a high level of comfort that what you're proposing to actually do, we can do. So if you're taking a single unit site at the moment and you're putting a made up number, 10 houses on it, and with the resource consent, it gives the funder great confidence that you can actually put 10 houses on it, and not only 6.
And if you think about it quite simply, once you put a finance application forward and someone commits to financing a project, they've committed the money there. You alluded to earlier before, there are capital constraints in the market at the moment. So if you don't have a resource consent, someone's not going to commit to your project. So that resource consent is really the first key gateway. And so what we would typically say is, provide us resource consent, give us a set of plans, statement of position for the sponsor. So whilst we might not necessarily be cross-securing with other assets, normally we wouldn't. They want to know what is the position for the borrower. Have they got the ability to fund cost overruns? Are they, able to assist the project if it does run over time, over budget? The other thing that they want to know about is the experience of the person borrowing the money. So have they done a project before? What did that project look like? And if they haven't, how are we managing and mitigating that lack of experience? Are we putting Paul in on the project? Have we got a good quantity surveyor there who's the head contractor, the builder, etc. Through there? And perhaps sort of the most important thing and what is a cornerstone is that detailed feasibility on a project, and that's a full feasibility from top to bottom, including realisation on the properties, what your land costs are, all your consultant costs, local authority fees, finance, it's everything through there. It's
Ben,
quite
do you mind if I interrupt there and just say the feasibility, how does someone get a feasibility done? Because let's just say I've got, I'm going to do this thing, but who's going to help me figure out how much it's going to cost? What type of person do I find?
Yeah, and that's quite important for anyone who's a novice. If it's your first time doing a development, it can be quite daunting. There'll be, we've got a free downloadable feasibility on our website.
But it's getting the numbers to go in.
It's finding and it's putting, rubbish in, rubbish out sort of thing. So I think what's most important there is if you are first time into property development, is to engage with a consultant early.
What kind of consultant?
It can be varied. So you could engage with someone like Paul. You could find a quantity surveyor. Some architecture firms are good. Some building companies, large scale, your GJs, those kind of guys are very good at working with you on putting a feasibility together. So there's plenty of people out there. I would definitely recommend speaking with one of them.
I
early
suppose
on.
you could always put on Subdivision New Zealand a request, but just
sorry,
remember
yes.
you'll get a lot of people that may
Yeah.
tag to say they can do it. One thing I'll say is do due diligence.
Yes.
You need to check your experts out.
Yeah, so the thing with the feasibility is, from a funder's perspective, is they want to, again, it's a bit of that showing you're working and doing your homework, and it's got to be tested and validated. So if funder's sitting there saying, in this case here, Paul, you think it's going to cost $3 million, whatever the case may be, and it's like, prove it. And the ways that you go about proving that is engaging, like you said, professional consultants like a quantity surveyor who are sufficiently qualified to do that, or actually going out and getting real quotes. So in my case, for this project, I would try and shortcut the quantity surveyor requirement. Being a cheapskate, trying to save some money. And so for me, I could sit there and go to a bank, I've got 20 years experience, blah, 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 but they'll still sit there and say, well, prove it. So the way that I would do that is I'd actually go get quotes. So what I would do is I'd get a builder's quote. So we know the cost of the land, that's a given, I can prove that. In my particular case, we know the cost of the resource, consent fees, etc., because I've actually incurred the costs. I can give them the invoices. So then they'd sit there and say, how do I prove the cost of all the consultancy fees? Well, I can prove that too, because I've paid half of them and the other half I can show quotes. And then, on the construction cost, I could either go to a builder, we'll pick on GJ Gardner again, and I can go, here's a lump sum fixed price from a reputable builder, and that would support it. Or in my case, if I'd want to project manage it or construction manage it directly, what I'd have to do is I'd have to go and show the 20 trade quotes and actually build it up in a spreadsheet and attach all those quotes and do my homework and prove it. And then, having gone through that process, land's a third of the money, the consultants are like another $100,000, the build cost was 1.4. And if I start proving all of those, what I'm doing is I'm giving them proof of about 80% of the costs, and it substantially de-risks.
Yeah, 100%. That's exactly right, Paul. And so those items are the key things to put an application together. And that's kind of, I guess, the minimum benchmark, the low bar. There would be other things we'd need, particularly before we draw down any funding, and that would comprise your building consent, and that's quite important. It may be any pre-sales or pre-leases. They are becoming more and more important in the market. Even in the non-bank space, there's a heavy requirement on pre-sales now. Your build contract, that's quite important, all of those contracts and of your sub-trades. You may require a QS report. You may require a valuation report there as well. So there's just sort of some other things to address. Something I guess we've kind of danced around as well is when to engage with people, and I think that's a really important question. And I'd say the earlier the better. And my dad always sort of had a saying, you make money on the way in, and that's the acquisition of the land. And so if you're looking at a site to buy, to do a development on, it's a great time to start speaking to someone about what that development might look like and start building out that feasibility. And we were speaking offline before about the importance of, when you're first considering a project, making sure there's a really robust margin in that project. And it might mean that you have to be exceptionally patient. Something I work off is sort of 30% plus. It's not always achievable, but we tend to find that 30% becomes 20% over
reality,
12 months. If you bought a piece of dirt 12 months ago, or 6 to 12 months ago, chances are you're just coming to the point now that you're going to develop it, and you're seeing, as you alluded to, build costs have come up, finance costs have come up, pre-sales are hardened. So having that robust margin at the start means that when you're at this point, it's still a viable project.
Or it's easier to get across the line. So if you took that scenario of in the heat of the market and the buoyant times of 12 months ago, we want to brought a site and start to put a project together, and if we could show, say, 30% on paper then, and we've gone through the process of testing and challenging it now, and maybe 30%'s turned into 15%, so it would still be marginal, but the difference is it might just be another pre-sale, or it might be a personal equity contribution, or it would be a smaller bridge to gap, whereas the sample of my project, it's on life support because the margin was never it's truly not viable. We joke about it when we say it's unlicensable because the margin was never there, and it's
Yeah, and when you're doing that feasibility, it is really important to get all your costs in there. I mean, we see them quite often that they don't have the land value in there. I mean, land is a cost to a development project. You need land to develop on. Missing out your finance costs is a big one, and they can be quite a lot. They can be a big part of a project. So
and they're a much bigger part now than they were 6 months ago.
And I think on the finance costs are actually quite tricky to work out, and they're going to be different for different people depending on the complexity of the project and how much equity you've got. So the sample that we've used here, I'm not saying I am, but if I was a squillionaire and had lots of equity, and this is a very low risk project, I'd probably be able to get the cheapest money in the market through a main bank, and you'd be talking a much lower number.
You'd be funding it yourself, actually.
But if it was, say, a very large and very complex project, let's say it's 50 units, and it goes beyond the rounds of anybody's personal contribution to it, there's brokers' fees, there's valuations, there's different margins because of lenders, there's line fees, etc. And what I would suggest is that when people are preparing feasibilities, is to actually engage with somebody like yourself and work with you to assist on what the finance cost is likely going to be. What I find on all the feasibilities that I do is the line that changes the most, and the one that we struggle to get right through really that first sit down with a high level pen is the finance number, and it's due to a whole lot of parameters.
I agree with you, and like you've alluded to, it could be a bank, a non-bank, it could be a bank and MES, it could be many different combinations that all have a different answer to how much that finance cost is. I mean, that's sort of, I guess, what I'd need when I get engaged. In terms of gateways for lenders, there are sort of thresholds that are creeping into the market. As I said, sort of pre-sales, pre-leases are becoming more important. As Paul's alluded to, there are capital constraints out there at the moment, and what you're finding is funders are looking more at the low-hanging fruit. So the less risky a project is, the more likely they're to take it on. So things like that are becoming more prevalent even in the more aggressive lenders sort of space. So I think pre-sales are important, but they're very hard to get. Good build contracts are key, and I think negotiating a strong build contract is really important. We touched on it before, and about having reasonable terms for both sides of the fence, and making sure you leave enough in it for the builder that they're not going to put themselves out of business trying to do your project, whilst leaving enough tension in there that you can have some leverage and move them along and look after yourself. And I mean, you do that all the time, right?
Absolutely, and Hakimi Exo and I, speaking of contracts, pre-sales, make sure you get some good advice on them first. Quite often we find projects come to us, they think they're sort of ready to go, and we go back and we have to unwind things, and unwinding pre-sale contracts are exceptionally tough, and it's not something you want to be doing in a downward market. And things like not having a 10% deposit is just criminal. You really need a 10% deposit for any lender to consider it. Substitution of materials, particularly important at the moment. There's the jib shortage we speak about. So if you want to put an elephant board, you need a substitution of materials clause in your pre-sale contracts. Good sunset dates. There's program delays. You want 12 months past your expected completion date. There's all various different clauses in there. There's a power of attorney clause, which I won't go into detail because it can get quite confusing, but that's another important clause to have that allows you to pull through the title at completion. So having the right contracts through all your contracts in the development, particularly pre-sales, build contract, are really important, and having good advice around those and dealing with the right people is key. And like Kirsty said, use the Subdivision NZ page for background checks, for good referrals and
due diligence.
With due diligence.
So just to repeat what you were saying and put simply, and that is before you start your pre-sales process, if you've got a funder online, show them a copy of the pre-sales agreement. Because you might think you can bank a sale, and the funder would sit there and say, no, we can't bank that. And then the second thing too is you effectively want a construction contract and you want to show that to the funder too, and that's really important. I don't want to fall into a rabbit hole here, but certainly with banks, I find that banks can almost override a construction contract because they have a view on things and what's required to achieve funding and drawdowns. And what I'm finding is sometimes construction contracts end up getting bent by both parties because you're meeting the will of the bank.
Yeah.
The other thing too is you've got to also sort of check funding requirements because you may not have the authority to change something. You may not have the authority to extend the program, may not have the authority to change a material or to approve a variation without the bank's approval. So it's quite important to, again, just sort of understand what those requirements are. What I find is that people sort of start a project and next minute we're getting tripped up because we didn't understand a requirement. And what happens in my case is I don't get exposure to the funding agreement, and then we go to do a drawdown thinking we're doing something in good faith, and next minute the bank's QS, sometimes a bank will employ or a funder will employ their own QS, and they will have exposure to that contract and those terms, and they'll sit there and they'll go, no, that you can't do that, that's not an agreement in the funding, and it can cause pain.
Yeah, 100%.
Okay, so any other bits that you want to add for?
No, I think that's more or less it. The big take home, I think, is just engage with good consultants early and have robust discussions.
And throughout.
Yes,
Yes,
through the entire.
throughout.
Definitely, don't just have one conversation.
Yes.
And think you've learned it all and you can do it yourself.
Yep.
Development is a really risky business, and I'm not saying go and spend money for the sake of spending money, but spending time and engaging with good people has a lot of value through that process.
Yep, and just to recap, I think the important thing for people to understand is the funding, like you say, is not 2D, it's dynamic and it changes during the course of the job, and you've got to realise that the funder is a very, very significant stakeholder in the course of your project, probably greater than most people realise, and they have more say than most people realise in the ability to influence the outcome of your project more than you realise, and that it's key that you run these key documents, these key milestone elements past them, and that you keep talking to them.
Okay, so thank you.
No worries. Thank you.
So we've covered the Paul's feasibility, the macro environment, and what you want to see. So I think that wraps up the 3 key topics we wanted to cover, and it's time now for us to hand back to you, Stacey, as I understand. So the floor is yours.
Yeah. There's quite a few good questions here, so we'll try answer as many as we can. From James, is capital appreciation included in loan to cost ratio?
Yeah, so we can include the land at value in the project. So when you build out your feasibility, you can put the land in at value, and when you're looking at your equity, quite simply, that's the sort of, I'm trying to think how to say it. That's how much cash equity you've put in, but it could also be if you bought the land for $1 million, it's worth 1.5, and you have $500,000 loan on it, you can have $1 million of equity in that project. So you'd put the land in at 1.5 million and minus your loan off that, and that would give you your equity figure of $1 million. Where people can get caught out and where the feasibility can get very interesting is, and it's a little bit perverse, is the higher the land value you put in, because you still have to put it in as at value for the cost, will erode your profit margin at the bottom. So you can get caught up boosting your equity figure to the detriment of your property, your profit margin in the project. So it can be a fine balance to tread, but land appreciation can be included as equity in the project.
Cool. And from Pradeep, how much was the per metre square cost in your calculation?
3,200.
Yeah, that's right, 3,200 plus just, wasn't it? Yeah.
Was it plus just? Yeah,
plus
plus
just.
just.
Plus just, if memory serves me correct. Yeah.
Sweet. And from Will, if units are pre-sold, can the LVR and LTC be less favourable? Also, how do second-tier lenders differ from banks in the current environment?
Yeah, so
It's a good question.
there's sort of 3 key milestones we address when we do an application with a funder, and so that's equity, experience, and exit. So if you think about equity as equity, that's your loan to cost ratio. That's what we sort of know there. Experience is experience and who are the key parties involved in the project, but also yourselves. And then exit is how's the loan sort of being repaid. And what we tend to say is you can start pushing one of those three metrics. So if you have a very strong exit position and good experience, then you may be able to stretch that loan to cost ratio. I've got two projects I'm working on at the moment where we're looking to fund between 90 to 95% of the total cost of the project. But both of those projects have exceptionally robust sponsors. So good people with good experience and a really strong exit position. So strong margin, and almost all of the properties sort of sold in those developments. So the short answer there being pre-sales definitely assist you, taking on more leverage. In terms of how non-banks and banks differ, primarily banks are really sort of, there's a box fit in the box and they don't flex much in there. Non-banks have a lot more flexibility, and so they can look at a higher loan to cost ratio. They can look at an owner-builder relationship where a bank may not. They could look at little to no pre-sales. They could look at various different items that a bank just will not consider. A bank is kind of 70% loan to cost, 100% pre-sale cover, and reasonable experience, and we're kind of happy to support you. And if you don't tick all those three boxes, maybe don't talk to us, go talk to someone else. So that's where a non-bank lender comes in and affords that level of flexibility to say, okay, well, maybe we've only got 50% pre-sale cover and we're looking to borrow 80% of cost as opposed to 70%. So there's greater flexibility there. And they're also more expensive.
Cool. And there's a couple from Nash. The first one, in the current environment of possible market correction in regards to house prices, how are banks and second-tier lenders calculating final value of developments?
Yeah, so there's still a reliance on evaluation. That's quite important. This is where pre-sales are becoming more and more important, and so 6 to 12 months ago, non-bank lenders would go ahead with no pre-sales on a development and sort of allow you to ride the risk of selling on completion. In this current market, we're seeing pre-sales become more and more important. What you'll find is the banks will probably start shifting their pre-sale cover from 100% or one times closer to 125, 130%. And the reason they'll move that needle is a forecasting of default risk on purchases. So that's sort of saying that we expect maybe 30% of the purchasers in a development to not settle on their properties at the end. And people might not settle because the value of the property has fallen by 20%. You've got a 10% deposit in there, just walk away from your deposit. So that's where the pre-sale requirements coming in, and having good, robust pre-sales is quite important. So we often speak to people about having home buyers as well as investors as purchasers of your properties, and making sure you do good due diligence on both. But in simple terms, investors are more likely to walk away from a deposit than a home buyer. An investor has a more commercial and practical outlook on life, and if the property values fall so much so that they're in a loss-making position, they're probably just going to pack up and walk away. Whereas a home buyer tends to sort of sell that emotional journey of, I'm going to buy my first home, I've saved up all this time for this deposit, I want to get in there, and they're more likely to follow through. So you may consider an investor less of a credit risk. However, a bank would prefer owner-occupiers, home buyers as purchasers over investors to a certain degree. Did I answer the question right there?
I think you did.
Yeah, okay. What was the second question?
The second question is, are 5 terrace houses development considered as a retail or commercial lending by the bank?
That'll be commercial. So the banks kind of cap out at 4, and there's really only ANZ that would consider that in the retail space, or ASB possibly as well in the sort of retail business space. But it would likely be treated as a property finance transaction.
Yeah, and this is where, if we go back to that, the first webinar that we did, and I had a quick conversation about which way to go, like max out or max out the number or max out the size. So that particular person, they might sit there and choose to change strategy and go, well, rather than doing 5 terraced houses, let's do 4 freestanding houses because the funding route might be easier. So this is where it's important to sort of talk to a bank early, because that particular person.
Or an advisor.
Sorry, yeah, broker. My bad. Earlier, because you don't want to go down a journey of 12 months of your life in a resource consent to discover that what you're doing is a dead end or very hard to fund. Whereas if you can get strong feedback now, you can take quick and instant corrective action.
Yeah, 100%.
Cool. And sorry, just finding all the questions. From Will, how is it that some developers pre-sell all units before resource consent even granted, or are these ones with deep pockets who don't need funding?
Yeah, we actually spoke about this about an hour ago.
Yeah.
So you can theoretically you can sell a project at any point in time. You could draw up a couple of renders and put a contract on a piece of dirt and start selling them down. The risk you face is that your resource consent gets issued with a different format than what you've sold, and you're going to have to go back to buyers and cancel contracts or change price, change terms.
Yeah.
You're selling exceptionally early on in the piece, and you may end up finding that your sunset dates have to be very, very, very far in the future.
Yeah, I'm probably going to slide into slippery territory here, but what you've got to realize is some of the larger, well-known developers, without naming names, are primarily marketing companies who just happen to sell property. And so what they're doing is they're focusing on sales. They've probably got more salespeople than anybody else in the organization, and their ability to get pre-sales is primarily their marketing business.
Yeah, there's a huge element. And as well, some of the bigger guys will have set designs that they know will go through council and work on certain sites, so they can be more certain of their resource consent process.
Yeah.
But if you're a novice developer or just doing a few, I would definitely recommend waiting until you have resource consent before starting that sale process.
Yeah, because it's also a challenge with your lawyer. More educated lawyers from a purchaser's perspective will sit there and say this doesn't even have a resource consent, and then they'll be giving the potential for that client advice that it's saying you've got to realize there's a whole lot of risk here. At which point you tend to scare people away.
Yeah. So
it's more that pre-sale prior to a resource consent is something that's probably going to be an investor's product, where it's a yield, or they're relying on hoping that this project takes many years to be built and that they're going to get a capital appreciation at the same time. It's sort of a different sort of product and a different sort of strategy.
Yeah, no, agree.
Cool. We'll make this the last question. Is it from Pradeep? Is it advisable to get a QS report from an independent QS surveyor or a builder? My project involves substantial driveway and retaining wall costs, hence evaluating builders versus QS surveyors.
That's a tricky question.
So I would do all. So if it depends on the level of detail and information that he's got. So what I would do is, builders, I don't know whether a builder's getting a quote. So let's start from the top. So what I would sit there and say is what you're trying to do is get the most information and get the most accurate answer. So the most information, the most accurate answer is if there's already a building consent or some sort of detailed design for the retaining wall in the driveway, I'd go get quotes from a contractor, because that's the real number. It's no estimation. It's a real company that will build it prepared to enter into a contract to build it for that much money. So that's your greatest level of certainty. Alternatively, yes, I would talk to an independent QS who will provide square meter rates and base on market adjustments and feedback that they're doing on other other projects that they're regularly pricing. And then, I would talk to a reputable builder. But again, you just want the reputable builder to show their working. So if they're talking to a retaining wall mate and their driveway guy and there's some substantiation to the number, I would kind of have confidence. So I guess I'm not sure if that answers your question, but what I would say is that it's not necessarily a specific individual. It's trying to, whatever the number is, it's trying to have confidence that the number is true and accurate and somebody showing the workings to support it.
Yeah, the earlier on might lean you more towards a QS.
Yeah.
And when you do engage with a QS as well, important to be discerning with who you speak to. particularly if you want to use that QS to add robustness to a finance application, because a lot of lenders will have preferred QS parties that they deal with, particularly the banks. So making sure that QS, and you can talk to them, are you on any bank panels? Have you worked with funders? What funders do you work with? And get an idea for, are they suitable as a QS to take you further through that funding process?
That's really important. Yeah.
Cool. Great answer to finish this off. There were a few questions that refer back to the previous webinar, so I would suggest to the audience, if you missed that first one, to go watch that. The links in that chat there. Cool. Thank you, Paul, Ben, and Kirsty. Yeah.
If I can just butt in, if people want to ask any more questions, get them to post it on the Subdivision New Zealand site, and Kirsty, Ben, and myself are happy to continue a conversation over the next day or two. So if there are any questions that we didn't answer,
Well, you're going to say the next hour or so.
no, we got next day or two. So feel free to ask questions, and we're happy to answer. And not being on the spot, you might get a more robust response from us.
Because you don't mind writing 3 paragraphs.
Yeah.
Cool.
Sorry.
Yeah, that's a great idea. No, perfect. Yeah, thank you for everyone for attending, and thanks for coming on and talking to us. I learned a lot myself anyway, so I'm sure that was really helpful for the audience. We'll see you at the next development series webinar, roughly in a month or so. So yeah, thanks guys.
Thank you,
guys.
Stacey, and
Thanks,
thanks
everyone.
everyone for watching.